Hello everyone. Welcome back and a warm welcome here from the enmacc offices in Munich. Thanks for tuning in. This is the last episode of our Digital Trader Summit series, number 16 this year, in this special year. And we are ready to close the series with an outlook on the gas market. Again, I'm very happy that we have an excellent guest with us. We are collaborating closely with Refinitiv. I think it's known that we integrated the enmacc platform with their Icon Messenger service, but we are as well benefiting from the excellence they have on looking on the markets and sharing that with us and with our community. So I'm super happy to have Bryan with us. He's the director for European gas at Refinitiv, and I've seen already the content. He has brought quite some slides with him, and I think very good timing, excellent knowledge here. So really happy to have you in this session. Thanks, Bryan. I'm handing over to you.
Hi, Jens. Thanks very much for the nice introduction and welcome everybody. And again, thanks for enmacc for inviting me here to speak. I'm just going to share my screen. Just give me a moment. Okay, I think we can see the screen correctly. Is that right, Jens? Yeah,
yes.
Good. Okay. So what I'm here to talk about today is just European gas, winter 2021, and also just to look back to what happened in the run-up to this winter, and of course at the start of the year, when we come out of the winter season last year, and then the global pandemic hit. So I've put together a few slides here. Some of them I'll go through a little bit quicker, but there's some I'll spend a bit more time on. So let's take a look back. So first I want to look back at the gas hub collapse. Now I've called it a gas hub collapse because you're going to see in the next chart, these gas hubs now, as we can see, are a lot more correlated. As we can see here, prior to previous times, there was a lot of difference between these hubs. As we've started to really converge and the global gas markets have become, not one, but they've become a lot more linked, we've seen that in the price action. So just looking at the start of the year, we came out of the winter and actually it was already looking quite bearish. We had, in the run up to last winter, we had concerns around Russian transit. And then once that was actually solved, we then saw storages were high, the weather was mild, LNG send out was high. So we were already quite bearish going into the summer here at Refinitiv. Fast forward a month or so, February, the start of the pandemic, onset of this global pandemic, saw a lot of weakness in future and current demand. We saw power demand down, we saw industrial manufacturing down, we saw external fuels were collapsing, collapse of financial markets. It was like what I'd call like a bearish cocktail. That saw a lot of these global gas hubs, as we can see here where I've circled, fall to record lows. We saw TTF day ahead summer 20 averaged at 6.4 euros a megawatt hour. That's not what we used to see. And if you look back, we're normally trading around this level. So it was a real surprise to see it so low. I think the actual real intraday low was around 2 euros, but I think we actually saw even some bids and offers even negative. NBP suffered similarly, averaging 20 pence a therm, same sort of situation. Me living in London, the national lockdown really exacerbated that. And not just London, we saw large swathes of the planet being subject to large levels of national lockdowns. Social distancing also happened. That also affected maintenance season, another impact on gas markets. In the summer, we normally do a lot of maintenance, but social distancing, again, curtailed a lot of their maintenances. Some of them been pushed forward to next year. Then what we saw was the real big driver. As prices really started to sink, we saw a reaction from the US market. Henry Hub really started falling. Then we saw the cancellations of a lot of cargoes into Northwest Europe and Asia. This woke up market participants and it kind of lit the fuse for the start of the rally that we saw. I've got a couple of more charts here, but I'm just going to not spend too much long. Just a similar pattern was seen in, as I mentioned, external fuels. We saw API front year collapse down to these levels. It actually has recovered in short term, but that's another story. But a lot of this contributed to what we saw in gas, even the carbon market, which actually has recovered very significantly in the interim. That also collapsed in line with what I also call, like, for me, it's like a bellwether of demand. So I look at the global world share index, which again, you see here, it collapsed to a low. And you can see the relationship with the crude market. And this also fed into the activity and the actual price action we're seeing in the gas market. So that period we saw where prices collapsed was kind of vindicated when you look at what was happening behind the scenes. Looking at COVID-19 demand impact, demand destruction, as you can see, happened. What we're thinking, well, not what we're thinking, what we're seeing now though, is as we move into the winter and with more of us actually at home, we're seeing more of an impact on demand there. So we had a really cold spell in some parts of Europe in early October. And of course, over the recent days and weeks as well, we saw additional cold spells. And as you can see, the LDZ actual here is a lot higher than what we'd expect, even without the COVID. And there's an interesting number here. In London, for example, a one degree increase in temperature or decrease equates to around 7 MCM per day of demand. So we saw temperatures fall to close to zero over recent week. And then that equated again to that around 70 MCM increase in LDZ demand. So for me, it kind of shows some of the impacts of COVID-19. Obviously, we all know the proper impacts from manufacturing, from traveling, etc. But the heating demand one is one that really interests us. And I think it's one of the things that we highlighted as a potential risk factor for the remainder of the winter. But again, that's dependent on the lockdown status. So as we can see, the LDZ, non-LDZ got actually affected a bit more, which is not a surprise. But overall, COVID-19 has affected gas demand, infrastructure in many different ways, and it continues to do so now. What we saw here was the reaction in terms of market share. You can see here, you see Russia were one of the first to turn down. They did push a little bit more through ESP, but in terms of pipeline supply, they were down. Norway, they also adjusted lower as well. Looking at Dutch production, that's adjusted low for a couple of different reasons, but that's also, you can see that's a factor that contributed to a bit of tightness. One of the things you can see, and it's quite apparent, is LNG. Now, of course, we know about the big ramp up in 18-19, but even this year, LNG market share has continued to rise at the expense of what we see here in terms of Norway and Russia. So that part of the market really was a bit of a surprise. Looking at Gazprom exports to the EU and UK, you can see Gazprom here, their exports have really slumped. Once they were already falling before the pandemic, but once the pandemic actually struck and we saw the cascading effect on gas markets, you can see the effect on Gazprom's exports to the EU and the UK, which again kind of tightened the market and helped fuel a bit of the rally we saw moving forward. But for me, this was one of the main drivers. US LNG cargo cancellations. No one expected cargo cancellations to be this high, and it really sort of sharpened market participants' focus on the coming months and whether indeed we would have enough LNG. Price economics obviously were not supportive. So as we can see here, we saw around 25 in June, 40 plus in July and August. September, it starts to fall, October, and now we're seeing the effect of increased export economics, making it more financially attractive. And as you can see, the cancellations have started to slow, and US LNG is now flooding the market once more. I'll take a pause and look up to the run up to winter 20. I've mentioned some of these points earlier, but I still wanted to highlight them. So again, you can look, this is purely just TTF day ahead. You can see the bottom of the market I was alluding to earlier. This is the run up I was talking about. What we saw, and this comes from our own Refinitiv winter gas research. This was what we said. We said, assuming normal weather conditions, we did indicate a slightly tighter Northwest European gas market compared to last winter. We did say there was a potential for a small reduction in pipeline supply from Norway and even some from UKCS and Russia, continued reduction from the Dutch Groningen field, and of course, lower transit volumes of Russian gas. But we did expect, and this is what actually has come true thus far, we did expect strong LNG send out to return this winter, bolstered by improved US LNG exports, which is what we've seen. We also had a bit of colder weather as well that sort of supported this run up to prices. And even when we got into the winter season, you can see here, prices continued to trade a bit higher until the temperatures actually started to adjust higher themselves. And we saw temperatures and prices start to adjust. One of the reasons the tightness this year was LNG. We saw a reduction in supply, by 1 BCM, or increase in demand. So that surplus of 1 BCM translated into further market tightness and also shaped our view for the coming winter. Looking at Norway, last year, Norwegian exports were down 2 BCM from gas year 18. A lot of this was driven by a combination of field maturation and also commercial reductions. We see the flexible fields, for example, Troll and Oseberg, both operate this way. So price action as well wasn't actually viable for Norway to increase that production. If you look at our winter 20 forecast, we look at Norway here at 56.1, which is kind of in line with last year, but this is more about higher production from both the flexible fields. We are seeing some maturation on larger fields, which will help the decline, but what we're seeing this year is we're expecting Troll and Oseberg to really start flexing, and we've seen evidence of that flexing already. And if you look at the spread between the NBP day ahead and also the front summer, you can see that spread is around 7 pence now. That definitely incentivizes more production and from Troll. And obviously Vesterled as well, we're seeing more supply via Vesterled. So Norway, if you look back to previous year, it's a little bit lower, but that's to be expected, but it's still at a reasonable level. And we've seen Norwegian supply over recent weeks has been very stable and at levels we'd expect, especially into the United Kingdom. Looking at Russia, we saw Russian supply, as I mentioned earlier, it fell. We saw a higher ESP, so they were pushing a lot of volumes through ESP. But don't forget as well, a lot of the long-term contracts and off-takers started reducing their offtake to the minimum take or pay due to some contracts being oil indexed. So we saw a bit of a shutdown there. We said here in September that we didn't see Nord Stream 2 starting in Q1-21. The last few days, we've seen some news around that. I think the ship is now on its way. So we may see some Nord Stream 2, maybe Q2. But again, with the US and the change in leadership, and Joe Biden might have other things to say about that, but maybe he won't be as harsh as Trump. So perhaps we could see that. One thing we do mention here is, and something to take note, Russian supply is going to be limited via Ukraine from 2021. That contract has expired. And the new contract has come into play. So we're only going to see 40 BCM in 2021 compared to 65 BCM in 2020. And what we've seen already is exit capacity at the Ukraine-Slovakian border for January has already been reported at 125 MCM, which again is, as you can see, is about 50% lower. So that's definitely a concern. But we see Nord Stream and Velki flows have been very stable. Our main concern here is what happens in terms of the lost volumes via Ukraine, but Gazprom's been pushing volumes in many different ways this year, so they will find a way. Ukrainian storage is a new one on us, and this for me is a real, has really had an effect on the market and also gives us some more supply confidence. At the time, around 8 BCM was stored by non-residents. When I say non-residents, I mean people that are not from Ukraine. What they did was they put a discounted service in place, and they really have incentivized European players to push gas into storage. And as you can see here, you can see our estimates of the prices and the regular tariff. And under the short haul discounted service is 2.6 euros per megawatt hour, which has really seen a lot of volumes head that way. However, one thing about this is you can keep this gas in storage for 1,000 days or around 3 years, which is very different to other storages. So there is now the option to, you can push that, you can maybe send that back into Europe next year. And again, looking at the spreads, there's always give you indication of whether it's going to be worth seeing these Ukrainian volumes. However, what it does do is give us supply confidence if something happens in the market, and generally we know it does in the winter. We know not only have we got EU storages or European storage, but we've also got this additional, as we call it, new source of flexibility. So as you can see here, you really saw a lot of the volume start to get injected. That also added to the bullishness as well, because gas was being taken away from Europe and put into Ukraine. I'm conscious of the time here, but I'm seem to be moving at a good pace. Looking at winter 20 to date. So for one thing, I'll start to look at is development of Northwest European storage inventories. As we know, is a key indicator for market tightness. The storage movement we've seen in the first few months, as you can see here, is very much in line with our forecast. The yellow dotted line is our forecast that we give to the market sort of early September. And so far it's behaving in the way we should. We had a slight cold spell over recent weeks. Storage has stepped in. We might start to see some more injections now because temperatures are about to start warming up. When I say warming up, I don't mean get the shades and the sun lotion out, but it's going to be a lot warmer than it was. And actually, it's going to be quite mild as per the last couple of winters. So we still believe these storages actually could end the season a bit higher than we forecast, but it depends on what happens over the remainder of the next few months. One of the big pushes, one of the big factors in the LNG export levels we're seeing, as you can see here, we set a new record in November of 9.4 BCF per day. So these LNG exports in November were 17% higher than the previous monthly record that was actually set in January. What we can see here, and it feeds into what I was talking about earlier, everything was looking rosy. The pandemic arrived and all of a sudden we see the decline in feed gas. Don't forget oil output decreased as well. So associated gas feed was also slowing down. What we've seen now and over recent months, as the prices start to rise, oil production started to recover, export economics became better. And here we are now with the feed gas. This is from yesterday actually, so it's very up to date. Feed gas levels were above the 7-day average, were above the 30-day moving average, which tells you that if export economics remain the same, which they are at present, looking at the spreads, and they should do for the remainder of the winter, then we're going to see an increased amount of US LNG on our shores. At the moment, Asia is first in the line, followed by MVP, then TTF. But that might change over the coming weeks if Asian demand doesn't materialize as some think, and including I think, we might see it a bit softer, especially when you look at the weather, but I'll come on to that later. This probably chart explains it nicely. This is showing how the US LNG exports have indeed improved. It also backs up my argument, what I was saying here about when the TTF collapsed, and obviously the Asian forward price as well, below the levels where they're actually economically viable. The reaction obviously was the cargo cancellations and what we've seen. And again, just echoing what I was saying in the last slide, but it's actually nicely visualized here. You can see as these forward prices started to rise above the voyage costs and the Henry Hub plus 115%, we've seen, as I've just said, record amounts of LNG coming out of the US. So it's a very price sensitive market. Very also as well, looking at the moment, it's like a battle between Asia and Europe as to who takes this LNG. Looking at the European LNG market, and I did mention there was a 1 BCM sort of reduction, we've also seen a series of recent events that have actually tightened the global LNG market. We had some production restrictions due to a couple of hurricanes, fire at Freeport, excuse me, the recent fire at Norwegian Hammerfest, concerns around La Nina bringing colder weather to Asia. I think we can't park it fully yet, but it's looking like that's not going to outturn as we expected. We've got some maintenance, we have some maintenance at Qatar at the moment, which we've seen has slowed UK Qatari cargoes and obviously Northwest Europe in general. That should be ending soon, or is starting to end, so we might start seeing more Qatari cargoes into the market. We've had the outage at Gordon. We've had some concerns about production in Malaysia, and the last two are the most recent ones, which are, we're looking, oops, sorry, excuse me. I need to work out how to go back now, which it's not letting me go. I'm very sorry about that. This was a Mac problem. I'm working on my Mac here, so I'll just have to get back in. Sorry about that.
Just to mention here, meanwhile, that we're happy to take more questions after the presentation. I think that's
thank you. I'm just gonna change this.
Take your time, and maybe the participants can already put some questions they have in the Q&A section or in the chat, as you wish.
There we go. I'm back. Sorry about that. This is working on my Mac. Has done this to me. Okay. All right, let's get back to where I was. So as I was mentioning, export economics improved, and we've seen now this large amounts of US LNG arriving in UK shores and obviously abroad. So the last 2 points I was mentioning was what we were talking about was the Panama Canal has got some issues now, and that's also contributing to a slowdown in cargo arriving to Asia, because if you go the alternative route, it costs more and takes longer. So that's also having an impact, and also freight costs now are quite high. So shippers are taking that into account when they're delivering these volumes into either looking at Northwest Europe or looking into Asia. So it's also having an impact. Let's go to the next one. Continental coal switching. Now, if you look at this curve here, the actual fuel switching prospects, unlike last year, we saw some switching. We've had a little bit here, but looking at the forwards, it's not looking great for the coal market over the remainder of the winter. We're kind of creeping into the bottom of the range now, which does incentivize some of the more modern coal plants to start producing. However, if you look at the forward curve, we've got a couple of months and we're in the bottom of the range. And again, the bottom of the range only really gets production from the most efficient coal plants versus the most least efficient gas plants. So really, we're not looking at any significant continental fuel switching over the remainder of the winter. And just to, as I mentioned here, with coal prices, well, they're actually quite high at the moment. We've seen supply side issues from Colombia. European stocks are around 2.5-year lows, but demand is weak. So I think further upside in that price is definitely unlikely. We have an in-house elasticity model. And if we look at Jan 21, currently trading around 14.50, was actually when I was writing it. Today has been a bit bullish, so please don't take me on that. But if prices were to fall by around €2, this would generate an additional 240 gigawatt hour of gas for power demand. However, if we see it go bullish and ride towards the CSP average, which is around €18 a megawatt hour, this reduces gas for power demand by around 450 gigawatt hours per day. So you kind of use that as a ceiling of to where TTF prices really could go if we get a bullish event. So yeah, I think the actual likelihood of much switching is very limited at the moment. Weather. Now we all find the weather is, I mean, I used to be, my background actually before I joined Refinitiv, I used to be a trader. I used to trade power and gas in the UK, across Europe and in Southern Europe as well. So weather for me was always key. And even before I joined Refinitiv, I was a client and I used to follow this guy, George Muller, probably one of the best weather meteorologists around. And I was always interested in his forecast because he was generally pretty correct. So I thought I'd share it here. You can see his December forecast is already reasonably good. He mentioned potential for colder spells. And he did talk about, and it could be drier than November, and we're already seeing that already. I'm more interested in this, January to March. Been looking at a lot of different weather models, weather output, weather house providers, and they're all kind of saying the same thing. Milder and wetter than normal, dry conditions in the south, but the main point here for me, temperatures will be mostly above normal with no major cold spells. That for me is quite bearish for the gas market, like it was last winter. And the latest DWD seasonal, another way of looking at it, also keeps the mild and unsettled trend for the entire winter season. So if this does outturn as it is, I expect this to really have a bearish impact on gas prices. And if in tandem, we see a continuation or an extension or any further COVID-19 lockdowns like we're seeing in France, the UK's in varying levels of restrictions. Germany might go back. So there's a lot of uncertainty around that. So if we have this warmer weather and further COVID restrictions, it's really going to affect demand. And I did mention before, cold weather could spur additional demand because of LDZ, but because of COVID. But if we are mild, then we're not going to see that. So the weather for me is also quite a bearish factor. I think I've been going 20 minutes now, I think. Okay, I think I'm doing reasonably well. Outlook for Q1 and up into the summer, really, I can give my outlook and some of my closing remarks. Now, you've seen this chart here. This chart here is again, gas share by gas year. And again, you're seeing what we expect is the same story throughout the year. LNG will step up. Russia and Norway will step a little bit lower, and Dutch production continues to fall in line with the latest announcements from the Dutch Economic Ministry, with Groningen likely to be phased out by 2022. So we've lost a little bit. We're going to lose a little bit of supply there. And UK continental shelf production is reasonably flat. So that main story for me is still going to stand in terms of we're going to see higher LNG and we're going to see a slight reduction in Norwegian and Russian volumes. I'm back to Ukrainian storage, but this is actually a different chart. This is the most up-to-date chart. So the injection season ended on 20th of October, historical high stock level, as you can see, of 28.4 BCM. 10 BCM of this is injected by European non-residents under the custom warehouse scheme I was talking about earlier. So with that, we know now we've got this additional 10 BCM of gas that traders in Europe or storage holders, can just release that back if prices do dictate that and they're actually making a profit. So we do see this again as a bearish signal. And again, if you look at the contango, we look at the contango at the moment, that might incentivize further increase in withdrawals, because with it being in contango, you might as well take it out now and send it in. Next winter, the prices may change, but at the moment, we're looking at maybe some increased withdrawals from Ukrainian storage with the prices as they are. However, given that they can keep it in storage for up to 3 years, as I mentioned, the amount of injected volumes until next winter will again be dependent on backwardation or contango state of the market. But yeah, it's, for me, as you can see, it's something that I think gives us this flexibility and can help manage any short-term spikes we may see in the market. Did you have a question there, Jens? No? Okay, fine. French nuclear, and again, when I was trading, this is, I'll call it an ongoing winter saga. Even the last 2 days, this has been about strikes, but there's always something when it comes to French nuclear. There's always a problem, there's always a concern, it always happens in the winter. However, what you should focus on here is 2020. This is actuals and forecast. And actually this year, we're going to see French nuclear output to be higher than the last couple of years, which for me gives a bit more confidence. And again, that reduces the demand on gas as well, and also helps interconnected markets where a lot of markets are reliant on French exports. So for me, this is another bearish factor. And looking out into 21, we've also got our forecast here for 2021 from our power team, kindly gave it to me. And this here, you could see where we see even more French nuclear output over the summer next year. So this is actually, for once, the French nuclear situation might not be as much of a risk factor as usual. But saying that, we saw the strikes happen over the last couple of days, and we've seen European power prices react accordingly. So that could still be ongoing if these strikes do continue. Lastly, nearly lastly, I look at other bellwethers. I've always looked at different bellwethers of demand rather than the usual, supply, demand, weather fundamentals. I like to look a bit further. So here I'm looking at Brent and also volatility. Now, normally they're very inverse. So if you see volatility high, it means there's problems in the global markets. Brent normally suffers. And again, we saw the VIX in Europe and the USA at record highs at the peak of the pandemic, and crude at record lows. What I'm seeing now over recent weeks, and the chart is quite explanatory, crude is starting to rise. The VIX is actually starting to slow, reflecting a bit less turmoil in financial markets. That to me translates to an increase in demand. Not only you can see from the global market, but that means gas demand, we may also start to see a rise of that. So always keep an eye on these different indicators to get an idea of what's going on globally and how that can translate into the European gas market. But I think with the VIX, that can all be quite volatile over the coming months. You've got the US election, you've got Joe Biden being sworn in. You've got his maybe change of tack in many different things. You've got Brexit, which it's been ongoing for years, but I think we're going to see some resolution on Sunday. And of course, you've got the word that I've mentioned far too many times over recent months, COVID-19. Again, far too much uncertainty there. But if the vaccines do work, we would expect travel to start to resume, people going about their normal lives, which again is going to see demand start to lift. So yeah, I always like to keep an eye on these bellwethers. Interesting slide that I saw at Flame, actually, that I thought I'd highlight. LNG growth is really going to slow over the coming years. This actually shocked me because I knew it was going to slow, but I didn't quite know the numbers. And as you can see here, there's only going to be 31 million tonnes per annum of capacity expected to be added over the next couple of years, average of 10 per year. Obviously, this was a growing market then, so you expect it to be high, but we've seen 95 million tonnes added there, an average 32. So it's 12 next year, and then it really starts to slow over the coming years. And if the COVID pandemic does actually get worse, we could see a deceleration. Some FIDs might not go through. So a lot of this near-term demand, again, is subject to so many uncertainties that this here could also slow. So it's just something I wanted to highlight a bit further out from what I've been talking about, because I do believe it has an impact. Lastly, you might be happy to hear, I've reached the end of my slide deck. I've just opened this chart back up now, and I stopped it there before, but now I'm just showing where we are now. Northwest Asian prices are really high. And I've just highlighted a few key points here. If you look now, Henry Hub's in contango now, so they're talking about, is the winter season already dead in America? I don't think so. TTF and NBP have been volatile at the moment, as I've mentioned. Weather's been a really key driver of that. Different forecasts have really been driving some of the movement we've been seeing intraday, intramonth. Also as well, I've mentioned the LNG exports. I think the Biden may have some changes in terms of that. I've read a few things, but nothing that I've read gives me enough confidence to actually say what I think is going to happen. So I'm going to wait until next year. Healthy demand in India and China. Now, will that continue? Everyone's talking about this extra demand from India and China. And I looked at recent PMIs which support growing demand, but will it continue? Weather in China, I looked at earlier before I did this presentation, looking at Tokyo, looking at Seoul, looking at Beijing. These temperatures from Jan 21 are forecast above the seasonal norm, above the average. So for me, that sort of cold weather or potential La Nina effect isn't there at the moment. It doesn't look like it's going to be there for the next few weeks. So that excess demand, we might see a lot more gas coming into Northwest Europe than we thought. South Korea and Japan are already weaker because thermal availability is higher. And also in South Korea, they're moving away from coal more towards gas switching. So again, that's going to have an impact. The weather is bearish, as I've mentioned earlier. Spot market is slowing down. We've got the startup of the TAP pipeline. I think it's already started up, but there's been no commercial flows yet. That's going to help. Strong Algerian flows into Italy as well. This is going to reduce Italian offtake of Northwest European gas. We've got new LNG terminal popping up in Croatia, which might have an impact on the southern market as well. COVID developments I've mentioned are going to be very key. I haven't mentioned renewables at all in this, but I think most people would know, especially I imagine for people here trade power, renewables have been very strong and also contributed to what we've seen earlier in terms of the exacerbation in terms of price decline. In the UK alone, we saw record levels of solar. And one thing you may not know is the lack of planes in the air actually contributes to the increase in solar. When planes actually fly, they release contrails, or what we see the trails in the sky. The lack of these contrails means the sun can get down even quicker. So we've seen record levels of solar across Europe this year, and wind speeds have also been higher in line with installed capacity. But as I always say, renewables are great, but they're intermittent. We still need gas as a source of power generation over the coming years anyway. More SPA from Gazprom, I've mentioned that. I think we're probably going to see a lot more push that way. Flexible field ramp-ups from Norway, starting to see that already. I won't touch upon EDF nuclear concerns. I think I've said enough on that. Nord Stream 2 might come on a bit earlier than we think. Not much chance of coal switching at the moment. And lastly, a weather-related thing. A few people have asked me, do you think we'll get a polar vortex this year? If so, what could be the effect? Well, I think at the moment, there's always a chance of a polar vortex. I think when it happened a couple of years ago, no one expected it. So for me, that can still happen. It can happen very quickly and develop quickly. And as I mentioned before, if we do get a polar vortex and we're still in lockdown and we're all at home, we're all going to have the heating on all day. And then that could be a bullish factor. But yeah, on that note, I think I've covered enough. Been talking for long enough. So thank you for your attention, and I hope you enjoyed my presentation.
Yeah, Wayne, it was excellent. Thanks a lot. I mean, lots of content, lots of touch points as well for discussion. So you mentioned already some of the still open questions. We received some questions around the Ukrainian storage. So technical thing, why is it limited to 3 years? Maybe you can explain that. And then as well, do you have any idea where the levels may be after this winter? Do you have an idea what storage levels we will see there?
It's a good question. Well, the first thing about the 3-year thing, I couldn't answer that question, but all we do know is that actually one of my colleagues is in the Ukraine, is actually in our Kiev office, so I will reach out to her and I can respond exactly why. But one thing I do know is that the majority of storage in Europe don't offer such a long amount of time as 3 years. So this 3-year thing is quite a new phenomenon to me anyway. So yeah, I'm not sure why they made it 3 years, but maybe to encourage more. But for me, if you're offering something the rest of European storages aren't offering in terms of this 3 years, then for me, that's like a USP, and they discounted it as well. So in that respect, I think the 3-year was a good idea, but I will, you can send me the email of the person asked and I'll get the exact answer from my colleague in Ukraine, who definitely knows a lot more than me. And you mentioned the price, or sorry, the level of the storage. Yeah. Now, again, it's hard to give a number because we don't know what the demand will be. We don't know exactly where everyone's actually put the storage and at what price. But I know one thing, if the prices start to get a bit bullish and head towards, like I mentioned, towards the CSP of average of around 18 euros on TTF, I can guarantee you, if I look back at the prices and see where these storages probably went in at, we'll see a reasonable amount of storages come out of Northwest Europe. But I still think it's a bit early to ascertain what the level will end at. But if you ask me in probably 6 weeks' time, I'll probably have a better answer.
But we get some questions here as well where people want to be a little bit more precise on where you see price levels, especially for TTF.
Well, I'm always asked this price level question. Now, I speak to people in the market. I've got my own ideas of price, but looking at this year, I mean, where are we now? Let me just have the exact price today. I think I still see, if you look at last year, and I didn't even mention, we've seen like a V-shaped recovery in the gas price. If you hear all this talk about V-shape in different economies, well, the gas market has had a V-shaped recovery. If you look at it closely, it's a proper V-shaped recovery. I would put the upside around last year's levels for me. If you look at last year's high, I'm a technical analyst as well, so I look at technical. I don't want to bore you with any of that today, but if I look at that, there's been a lot of activity. There's a lot of support and resistance around last year's levels. We've tried to test it intraday a couple of times. We've not quite broken it. So if you're asking me price levels, if we're looking at the current market and fundamentals remain excellent, I see the market reacting like it did here before the COVID decline, that is. I'm talking we're going to end up probably around the 10, 11, 12 euro mark if the market continues in the way it is. If we start going towards the more bullish side of things, there is a polar vortex and some of these things I mentioned do happen, then I see prices rising. But for me, I think 18 would be the high. I don't see it going higher than these levels we saw last year because the fundamentals are very similar. And we're still going to have this element of COVID disrupting day-to-day activities, disrupting travel, disrupting demand. I'm seeing in the UK, like the rest of Europe, shops are closing, airports are, the BA have moved everything from Gatwick to Heathrow. 2 big shopping centres are collapsing. I walk around even where I live and in central London, shops are closing, restaurants are not open, bars, hospitality, all these things take energy. So for me, I'd say that for me, that price action, if I was trading now, I'd be holding at the moment and I'll be looking to start shorting soon because I think it's going to start to fall once we get into the new year. It's still only halfway through the winter season. So for me, it's a bit early for an accurate assessment, but that's where I'd put it if you want to get if you're trying to get specifics out of me.
Good, excellent. There's a couple of more questions around competing different technologies and as well commodities here. First question in this space is the coal phase out, which was just decided now and basically operationalized in Germany, is that already priced in the gas market?
A lot of it's priced in, yeah. Okay. I mean, I did a presentation in Dusseldorf on this last year on coal to gas switching in Germany, and yeah, we've known about it. It's nothing new. Exactly. We've known about it, so for me, it's not a big driver.
Yeah. And on the other side, the renewables, you touched upon that as well. You see now with the shift to more renewables, more need for gas, basically filling in the gaps.
Yeah.
You see that? How do you look at that from an analyst's perspective?
That's going to continue. For me, that's going to continue. When I was putting together some research for our winter outlook, we released that in September, and I'll do some research before we look back at the summer. And these were also really great statistics on increased capacities, on increased new technologies, new ways of generating battery storage, hydrogen. There's all these different technologies that are going to reduce the call on gas. I mean, at Refinitiv, we only look out in our gas research team. We have a 14-day balance. We have an outlook that looks out 6 months, and we do a monthly, weekly report. In my previous role, I used to trade out 2 or 3 years, so I was always looking a lot further down the line. So now my focus is a bit more narrow, but I still do, for my own benefit, look forward. And I think, and I've been to presentations, speaking to peers and colleagues and etc. And gas has still got an important role to play, but I think you'll start to see it decline in the next, after 15 years or so. Everyone's moving towards net zero. I'm seeing a lot of new technologies. Even in the UK now, we've got green number plates. So now if your car is a green car, you get a green number plate. Not only does it increase awareness, but it makes people want this. It makes them transact. So behavioral change for me is the biggest thing. I think behavioral change is going to drive a massive reduction in fossil fuels. And people's attitudes are changing, working from home more, not traveling all these miles to meetings, etc. So for me, behavioral change will have a massive impact in harmony with technology.
Interesting, good. Maybe coming back a little bit to the European trading landscape. You mentioned the spreads widening again on the global scale, especially Asia being on top right now.
Yeah, Asia's really high, but there's reasons for that. I think it will tail back down.
Some speculation how this continued, you mentioned already, but we have seen as well changes in the spreads within Europe. I mean, now you see that the TTF Eastern European hubs are negative, the spread in a way. We haven't seen that in the past. Is that something we'll see in the future as well, or Are there new patterns in a way arising?
I think so. The market is changing. I've noticed that over spreads looking around. And you mentioned the southern market, and again spoke about this before. Is the Croatian LNG terminals about to start up, which can reduce some of the need for that. So, and we've seen the spread start to shift a little bit. However, I did mention that, and something to bear in mind is that entry-exit fees might make this uncompetitive. So it just depends. But I do see, even with because like I said, I used to trade the Hoopex, I used to trade the power in Hoopex. You can see it, even in Europe, it's starting to converge a bit more. And if demand does start to fall and supply stays where it is, then we're going to see even more convergence within Europe itself. So yeah, I do believe that is a trend that's set to continue.
Definitely makes it more interesting, right?
Especially with the new pipelines coming, you've got so many new ways of supplying now. We're a lot more interconnected, not only with gas but with power. So yeah, it's definitely.
Absolutely. Look, I'm looking for the questions. I think we are coming to an end. This was excellent. Thanks a lot. I think we are well prepared now for the winter months.
Yes.
With our webinar series here as well. So we will be back in January. I hope to see many of you again. Let you know earliest what the new topic will be. And we get lots of questions regarding this and the previous webinars. They are all available on our blog. So if you want to share some videos or review them as well yourself, they're all available on our blog. So feel free to download them there or review. Thanks a lot to everyone. Hope to see you. And special thank you to Wayne. Really
You're welcome. Thanks for having me. It's a pleasure.
Bye-bye.
Yeah, bye-bye.